maybe a little bit at the edge, but I think, while you're going to see some, I'll say, coming off of maybe some very strong housing numbers, at the end of the day, when you look at it in absolute terms, housing affordability remains very strong. And what Ben Bernanke did talk about is the fact that employment seems to be picking up. And if employment continues to pick up, if that's the real trend, in the end, people will be able to afford to continue to buy homes. So I think that's actually the crucial part of the puzzle.
I think that what we've got is basically a very, very fragile housing market, even though we've gone up about 13% insofar as housing pricing, if you will, but it's fragile. If we get interest rates up to this 4.5–5% 10-year, we'll shut that housing market down completely. In addition to that, you've got some legal issues out there and some other things that I'm sure we'll discuss later that are just going to shut that housing market down. So we have to be very, very cautious as to where this 10-year goes.
Yeah, I've always advocated that you have 10% in gold and gold stocks and you rebalance. And so this year you'd be buying gold at a PE ratio, cash flow ratio, lower than the S&P, and this big correction. And still over 10 years, that model has worked well. It's important to take a look at it from a year ago in gold as a currency, is that you look at what's the real interest rates. What are they paying you above a 10-year government bond? A year ago, it was a negative interest rate. The 5-year was a negative real interest rate. With the CPI coming out this past week, when you look at now in the capital markets, it's a positive rate of return on 10 years and 5 years, and that's always put pressure on gold. So do you think inflation is just going to stay at 1.2% when you just commented that housing prices are up 9% over the past 12 months? What I've always advocated is a diversified portfolio, and having a 10% weighting in bullion and gold stocks has been prudent.
Well, I can't think of a more perfect environment for banks. Think about it. If interest rates go up, that means their net interest margins widen. That's positive. If this is all happening because the economy is a bit better in places like housing and autos and capital spending, everything about this mid-cycle talk, that means more loans. If at the same time we're going to see a shift in funds away from the bond market to the equity markets, then that means more trading. It means more IPOs. It means more M&A activity. At the same point in time that the revenues will be moving higher, the banks will be going through this period of controlling their costs so they'll be getting positive leverage on their banking, on their income statements. I think banks in 2014 will earn $50 billion net after tax, which will be an all-time record. And I think bank stocks will go to about 1.5 to 2 times book value, which means that the world couldn't be better for banks than it is right at this moment.